Good afternoon. My name is Thomas Seneca. I'm the founding partner of TM Wealth Management, and welcome to our 2024 Market Outlook. I'm joined today by Matt Hartson and Brad Sorensen with Cornerstone Portfolio Research. We've recently engaged with Cornerstone Portfolio Research to enhance our market research, our portfolio outcomes, and our investment strategies. So we're excited to have both of them with us here today. And Brad comes to us with 20 years of experience at Charles Schwab, writing market research and also managing client accounts. And Matt Hartson comes to us as a previous advisor, but also as a previous CIO of a $1 billion endowment fund. Both Matt and Brad are CFA charter holders, so I think we've got adequate and sufficient insights and credentials here to really dig into what we think 2024 might look like. The format for today is really just a conversation. I want to highlight some of the questions that we're hearing from clients and investors, things that we should focus on and be aware of in 2024, and get a general sense of where we think the markets might be going, given what we know today, how we can start to be positioning things for 2024. So with that, Brad, maybe you can kick us off. Give us a little snapshot of what happened in 2023. I think it was a bit of a surprise for most people how well the markets did. But I think there were also some key elements to what caused the markets to do well in 2024. And if you think the markets or this rally can continue throughout 2024.
Yeah, thank you. Great to be here. Great to join your team. Excited about what we can do together. Actually, I'll give credit to my colleague Matt, who was actually more bullish than most of the market to begin 2023. He ended up being righter than the rest of us on the team. This is why we tend not to make a lot of projections, but most of the market experts, quote unquote, were negative on 2023 because the Fed was still raising rates. They thought we'd run into a potential recession. That was a big expectation at the beginning of 23. Never got into a recession. The economy remained strong. That helped the market do very well for 2023. And what was highlighted, what was unique about 23 was there were 7 stocks that really drove the market higher. And those were called, as you may have heard, the Magnificent Seven, mainly tech stocks, NVIDIA, Tesla, etc. And they drove the market higher. The other 493 they were still up, but not quite as much. So going into the new year, as we transition into 2024, we've had a little bit of a rough start, but that's to be expected after the run we saw in November, December. We still think we'll have a good year, but there'll be bumps along the road. There's a lot of issues that we'll probably get into later. But we think that the main story will be that those two, the 493 will start to converge with the 7. We can't keep having this big spread, but they will still both be positive, just the 493 will rise a little bit quicker than the 7 will.
Yeah, it was interesting. I think one of the research notes I saw you put out, Brad, basically showed the Magnificent Seven for the year were up, in the 70% range, and the other 493 were up about, in this low, high single digits, right, 8 or 9%. So
right.
I think what I'm hearing you say is we think that the other 493 are going to kind of lift a little bit, kind of catch up a little bit with the Magnificent Seven. And not necessarily that the Magnificent Seven are going to have a significant drawdown, but maybe they're not going to go up 70% this year. I think that's probably a safe call that we'll go ahead and make.
Yeah, I think we can make that call.
But as we look into 2024, there's a couple of key things that are happening in 2024 that aren't consistent events that happen every year, right? One is we've got a situation where the Fed is either going to be, raising or cutting. There's a big rate focus. And in addition, we've got, the 2024 election cycle. And how do you look at those, Matt, in terms of how we position portfolios? And obviously at TM Wealth Management, we take a long-term view, but we also don't want to put our blinders on and think that there aren't things and ways that we should be positioning ourselves to be aware of these major events that might be happening this year.
Yeah, no, I think that's a great question, Thomas, that you bring up, and thanks for having me join this afternoon as well. Great to meet the team and be part of the team here as we go forward. But as we think about those, I think that ties back to what Brad was talking about with our focus on looking to broaden the client portfolios and move beyond those big seven. It's sort of interesting if you look at those magnificent seven, they made up over 30% of the S&P 500. And a couple of sort of interesting facts there. The market cap of just the Magnificent Seven is 4 times the entire Russell 2000. So think about that. The Russell 2000 is a small cap index, 4 times all 2,000 of those companies. And so really big oversized impact. But as we sort of move into this and we start to see the market broaden and diversify here in 2024, and a couple of things you mentioned that I think are going to drive that broadening of the market. One is the Fed. The Fed at their last meeting said they were going to cut rates 3 times was their forecast. The market's priced in a 6 to 7 cuts. So that's a real negative risk from our perspective, is that the market is overestimating the number of rate cuts that are going to take place. If the market is wrong in that particular case, that could be a drag on those big seven. And again, that's back to that broadening that Brad was talking about as we see other performance. In terms of the presidential election, it's going to be a mess with the presidential election this year. There's no question about it. And regardless of where your politics lie, there's going to be a lot of issues here from candidates really doing whatever they can to promote themselves as opposed to promoting what's right for the country. With that said, we went back and took a look at history in various election years. And there's if you look at what's happened there over the cycles, regardless of who wins, Democrat or Republican, it's still generally been good years for the markets. The markets are up 70% of the time. The fundamentals, as Brad talked about, we think are very solid. And so the election is going to bring in a lot of volatility, a lot of noise. I'd encourage all the clients on the call to ignore that noise. Let us worry about losing sleep over that day to day and focus on those solid economic fundamentals that we think are going to drive the positive returns for this year.
Yeah, I think I was reading a note the other day, I think from some folks at JP Morgan, and one of their surprise calls of the year was going to be that one of the candidates will drop out at some point in time. And I found that interesting, but I also think what that's going to create, like you mentioned, Matt, a lot of volatility, a lot of ups and downs, and like you mentioned, Matt, noise that we can feel in our portfolios and in the markets. But over the long term and even intra year, you often see a significant drawdown in the markets, anywhere between high single to low double digits in terms of the market drawdown. But by the end of the year, more than 70% of the time, we're positive in the markets as well. And so I think it really is a year where you've got to be disciplined with what your strategy is and what you're trying to achieve in the markets, whether it be income or growth, appreciation, distributions, whatever it might be, and not be subject to the waves or the whims that might come because of the news or the headline risk that might be out there.
Well, and Thomas, I just want to jump in here real quick that we saw that everybody got an example of that in 23. That's the nice thing. We have a very recent example because we got calls at the end of October with clients wanting to get out of the market. They were sick of bonds. They were sick of stocks. We were at high yields. They were touching 5%. So the prices had gone down. Stocks were at lows. And we convinced most of them, hey, stay in the market. Don't worry. There's these up and downs. And you saw what happened in November, December. We both ended up quite nicely. And that's why you don't want to pay attention to those kind of dips that happen. The average decline in any given year is 14% during a year over the last 40 years. But in 33 of those 44 years, it has been up, regardless of that 14% decline. So that's why we focused on the longer term.
Yeah, and I think it's also, one of the key values that we at TM Wealth Management provide is really providing that unbiased, unemotional approach to investing, right? When it's your own money at risk, it's very hard to be unemotionally attached to it when markets are down. And when we go through our process, we really have a plan associated with our clients, what we're trying to achieve. And our role is to really execute the plan and help clients stick to that plan, not putting our blinders on, as we said at the beginning, and not just ignoring what's going on. One of the things at this time last year in 2023, it was like recession, right? Recession's coming, be prepared. get conservative, whatever you need to do to prepare for a recession, and it didn't come. So now at the beginning of this year, we're hearing similar type of talk. It's a little bit moderated, but do you think that there is a recession on the horizon for 2024? And what does that mean? Does it really impact any of the structuring of portfolios and investing strategies that we might implement for 2024?
I think the most important thing, and one of my favorite investing quotes is, it's not market timing that's important, it's time in the market. And I think this is going to be a year where that's really important to keep in mind. We don't forecast a recession in 2024, but as you just said, everybody forecast a recession in 2023. And so it's clearly possible to be wrong from that regard and to be surprised with what happens from the economic perspective. But as you've talked about, Thomas, we're not putting our blinders on. We have our base forecast, which is for continued modest economic growth, relatively low unemployment levels, continued wage growth, a lot of positives from the market. In particular, if the Fed does start cutting as well, that can be another positive. But you have to think about the reason the Fed is going to start cutting, and that is because they'll see economic growth slowing, and they want to make sure it doesn't slow too far as they're moving through that. And the risk, of course, is that it does slow more quickly than the Fed is expecting, more quickly than investors are expecting. So how do we position for that? That's really ties back to that portfolio structuring and talking about moving beyond those magnificent seven to some other names in the portfolio, making sure we're well diversified, thinking about bonds being a relatively attractive asset class at this point. It's been 15, 20 years since we saw bond yields that were 5% plus. Now, for a lot of investors, being able to lock in 5% returns, just even if they don't see any appreciation on the bond side, is still a pretty attractive return, especially after our 20% plus year that we saw in the markets last year. And so I think that's the important part. And again, tying back to what TM Wealth does such a great job of, is thinking about how to structure those portfolios to plan for what we're expecting, but prepare for the worst as well.
Yeah, and I want to kind of drill down a little bit more on your bond comment, Matt, and Brad, feel free to jump in. The last couple of years have been really challenging for bonds, and they haven't provided the diversification or in finance speak, kind of the non-correlated benefits that we expect them to provide, right? We expect them to zig when stocks are zagging, and that hasn't been the case. And so we've had some really challenging conversations with clients about, hey, why do I have this in my portfolio? And so as you look at that, and again, taking a long-term perspective and looking at how to structure the portfolio, where do bonds play, and how do you answer those questions for clients to say, look, if I'm gonna invest in something, I want the upside to be consistent with the potential downside, right? And bonds haven't met that metric over the last couple of years. So how do we now think about where bonds fit in the portfolio?
Yeah, Matt, I'm going to let you take that.
Okay, I didn't know if you were going to jump in on that one or not. So
no, I like to hear you expand on that.
Sure. So, if we think about bonds, I mean, it's always important, as we've talked about already, to not take too short-term of a view. So, actually 2023 was a really interesting bond year, and that bonds did very well to start the year. Brad talked about when everybody was very upset with bonds as we got moved to into mid-October there, as bonds were again trading back off, actually negative returns at that point. But by the end of the year, bonds actually gave us really solid bond returns. We had 7-8%, depending on the types of bonds that you were invested in, is what we saw from an overall return perspective. And what was really interesting is if you look at the 10-year Treasury yield, which is kind of that benchmark yield, as we started 2023, it started at about 3.9%. We saw that high that Brad mentioned of 5% in mid-October, but it ended the year almost exactly where it started, about 3.9%. So back to, if you're watching and you're riding those waves up and down, those waves of emotion throughout the year, you said, I hated my bonds. But if you just looked at the beginning and the end of the year, you said they delivered some nice income to me and a really solid return in my portfolio. Taking a little longer term perspective there, bonds, we've continued to believe they're going to provide good diversification, and they should also provide increased downside protection now that the coupon levels are more attractive. And I think that's a really important point to think about. If we go back, kind of coming out of the pandemic, where we were seeing 1% and 2% coupons on long-term bonds, that doesn't give you a lot of downside protection when rates moved up. And obviously that's what really hurt us in 2022. But if you look where we are today, when you're starting with short-term rates in excess of 5%, 10-year treasury rates around 4%, that's going to give us a lot more of that protection, even if a surprise comes up and the Fed has to continue raising rates. Nobody's expecting that right now, but if the Fed did raise rates, we can handle a 0.25%, a 0.5% increase in rates and still see a positive return from bonds. So I think they'll start to provide that diversification we didn't see when rates were so artificially depressed, sort of coming out of the pandemic there. The other thing we can look at, and we've talked a lot about from a portfolio structuring perspective, is thinking about some adjustable rate bonds to provide some additional diversification, some additional safety in there. When you look at some of those variable rate bonds, if the rates do go up, they adjust automatically with them, but they also have floors in place that keep them from dropping too low. And so that's another way we can further diversify client portfolios to hopefully have bonds play that critical role of stabilization during really bad events.
Yeah, I think that's a good point, Matt, that, when we look at, structuring client portfolios, it's not stocks and bonds, right? There's a myriad of financial products out there to help us accomplish the goals that the clients have and manage their risk profiles, right? Whether that's adjustable bonds or option strategies or private credit, whatever it might be, it allows us to manage the risk and in some cases lower the risk and increase the potential returns through portfolio construction. And so that's why for us, it's really important to better understand what the clients are trying to achieve, timeframes and risk profiles, because then we can use that information to utilize the tools in our toolbox, all the investment strategies, to structure a portfolio that helps them accomplish those goals with the least amount of risk.
Well, and I just want to point out that,
Sure.
yeah, bonds aren't this monolith category that we just
Yeah.
say, hey, bonds, we'll throw them in there. No, we adjust within the year. I mean, within the last year, we've gone from very short duration. That means the bonds that are due in a year or two into intermediate, because as the Fed has gone from raising to pause or lowering, that makes those more attractive. So you can just make those adjustments. And that's where it was Matt. I'll just tag on real quick to that to kind of bring in the Fed that we were talking about. That the Fed doesn't drive all interest rates, but a lot of their actions influence them very heavily. They actually only have the influence on the very, very short end, but you can see that treasuries at all maturities react to what the Fed does.
Right.
So you have to pay attention. And if you think, as we do, that the Fed is probably done raising or close to done, then bonds have kind of look pretty attractive here, because as rates go down or stay level, then prices stay level or go up in the bonds. So that's makes them a little more attractive than they may have been a couple years ago when the Fed was starting on their hiking cycle.
Yeah, great insight there, Brad. And give me a sense, what do you think about international, right? So, coming out of the pandemic and most recessions, it looks like historically the US comes out faster and valuations increase quicker, and it takes a little while for international. I know that's a big, broad bucket that can be, drilled down to in specific countries, but international usually takes a while. It looks like valuations internationally might be a little more attractive than valuations here. So how do we look at, the international exposure? Do we go down to specific countries? Are we looking for broad international exposure? Do we look at emerging markets? What's your thoughts on how to look at the international component of portfolios?
Yeah, I'm gonna so US investors are always underweight international. Matt has this great stat that how much of the international market is actually part of the global index.
Yeah, and so if you look at the global market cap out there of equities just around the world, the U.S. makes up only roughly 50 to 60% of the global market cap. So if we ignore international entirely, we're missing a huge opportunity set. And so, but Thomas, to your point, we only want to invest to the extent that we think we're getting a good return for the level of risk that we're taking. Right. And we need to factor in the diversification benefit. And everybody's talked a lot about a company like Coca-Cola, where whatever it is, 2/3 of their sales are outside of the US, and saying, well, I get my international diversification that way. We think there are some great great companies on a truly global basis. You think in the technology sector, someone like a Taiwan Semiconductor, for example, one of the leaders in that particular industry. And so you mentioned, Thomas, some of the key things that we're looking at as we think about international for the next year. What's been interesting, if you look back over history, kind of going back to the 70s there's been these long cycles where international's outperformed and then US has outperformed and vice versa as it's moved through. The most current cycle's at about 14 years of US stock outperformance. So for a lot of us, I'm probably the old one on the call, but for a lot of us, it's hard to remember and think back to the markets, 14 plus years ago as we're doing this. But if you did that, or you even think back to the 80s when Japan was going to take over the world, you went to your MBA programs for teaching Japanese management style and all of those things. So we certainly see those moving in cycles. We think this cycle's been pretty extended. And you talked about a couple of things we're looking at. One is valuation. Right now, US stocks or international stocks relative to US stocks are trading at about 2 standard deviations. So if you don't remember your stats class, that's about 70% of it worse than what they normally trade at as you're moving through from a statistics perspective. So they're very cheap relative to US stocks. And you mentioned in terms of the sort of the cycle, the business cycle itself. And if you think about where we are from the Fed, we're probably going to be the first country, sort of at least on the developed side, to start cutting interest rates. Why is that important when we're talking about international stocks? Well, it means the dollar's probably going to weaken. We've gone through a period of very strong dollar outperformance relative to other currencies. And so if the dollar weakens as we start to cut rates ahead of other countries, that also provides a bit of an uplift to our investors as US investors when we return those returns back to US dollars. And so there's I think a couple tailwinds. Lower valuation. We've been saying that for years, though. So we need that catalyst as to what's going to drive people to have that shift. And I think maybe a decline in the US dollar could be the start of that particular catalyst. And so we're somewhat up. We're not bullish on international, but shall we say maybe positively optimistic.
Well, and I want to jump on because I can hear clients out there right now because I've heard it before. You say you don't have blinders on. Well, you obviously do because the globe is a mess. And that is something that, but that's the one thing, and it happens in the US and here, the market is forward looking. So if you're worried about, and we're paying attention to, there's the dual conflicts in Russia and Israel, very concerning, but not economically, globally concerning, but humanitarily very concerning. And then you have kind of the US-China tensions, which have eased a little bit, but they still are pretty high. We are paying attention to those things, but the market and international stocks are well aware of those things. That's already into the market. So we think there are, like Matt said, valuations are really good, and there are potential positive surprises. It doesn't have to get much better, just a little better, and people will start to look a lot more at those international stocks.
Yeah, I think the kind of the key takeaway is don't get overly concentrated in the US. There are opportunities globally as well. So, we're kind of running towards the end of our time, but I think what would be valuable is just as we look into 2024, what indicators, what should we be watching that will give us an indication either on the upside or the downside as kind of where the markets are going and where 2024 might take us? What key, whether it's indicators, events, or themes that we might want to be aware of throughout the year?
Yeah, I'm going to jump in here because I do have an analogy. So what we have now is if you have a picture of a mountain and we got to the top with the Fed and they wanted the inflation to come down and the economy to slow. Well, we have done that. So the snowball is rolling. You've seen inflation come down. You've seen economic growth slow, but it's still positive. So what we want to watch is, does that snowball level off or does it gain speed? And that's right where we are at this point. Economic growth is still good, but the employment market is showing signs of weakening. Retail sales are decent, but they're showing signs of weakening. That's all fine. If it accelerates, then that snowball can start to pick up and we would look to get a little more defensive. But for now, everything looks good. And so those are the labor indicators, the inflation indicators. Like Thursday, we have a CPI. We want to make sure inflation doesn't go back up. Those are all the indicators that we're watching. And just the last point I'll make is last year's gains were all what we call valuation gains because earnings were flat in the S&P 500. So it was all valuation. So valuations are a little elevated. So we really need earnings to start picking up the pace and carrying the weight of the market. And there's 12% growth expected in 2024. So we're going to be watching very closely the 2024 first quarter earnings because that's when people will start to project for the whole year and see if we can get that earnings momentum going for the market.
And I think I'll just add a little bit on that because we didn't spend a lot of time talking about earnings today, and I'm glad Brad brought that up because that's obviously a really important piece where we're starting from these elevated valuations. Along with those earnings, we really want to watch the profit margins for companies. A lot of companies were able to throw in substantial price increases and blame it on high inflation last year, whether they needed to or not. Consumers are pushing back on that at this point. They're no longer letting the companies push those through. And so that's a number that we'll be watching pretty closely. Obviously this week sort of starts the kickoff of earnings season for Q4. We'll kind of see what's going on with those margins. How did those translate through? Can the companies, obviously the margins are what's going to drive that earnings growth Brad's talking about it because there's not enough population growth to get us 12% in terms of sales growth.
Right. Well, I think kind of the key takeaways, I guess, as I summarize here as we wrap up, is that we have a positive outlook for 2024, but there are some headwinds, some challenges out there that we need to be aware of and structuring portfolios to be prepared for. I think taking a note from Brad, I'll use an analogy as well, between sailing and rowing, right? When the markets, we've got, positive bull markets, we open up the sail and we ride the winds. It feels like this year we're going to have to pull the oars out and start to row to be able to protect portfolios, but also to get the returns that we might want to get within specific client portfolios. So it's more of a rowing year this year than a sailing year.